This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell. Hello and welcome to this week's AJ Bell Money and Markets podcast. I'm Danni Hewson, and it's been quite a week for markets after two of those magnificent stocks disappointed. We'll dig into Alphabet and Tesla's numbers and why markets have had such a reaction to their updates. With me is Charlene Young. Hi, Charlene.
Hello, Danni, and hi, everyone. We'll also be talking more about EV production as traditional automakers scale back their plans, and Ford considers its infrastructure as profits are battered. Plus, there's ongoing concern about demand for luxury goods, something we touched on last week, as LVMH sees slower than expected sales, and EasyJet bucks the trend of lower airfares and looks ahead to a record-breaking summer.
Tom Sieber and Ian Conway from Shares Magazine join us to discuss moves by consumer goods giant Reckitt to sell off large parts of its business. And Dan Coatsworth chats to an expert from Aviva Investors about what reflation is and how it impacts certain investments. Plus, we get an update on AJ Bell funds from Head of Investment Solutions at AJ Bell, James Flintoft.
Plus, good news for mortgage holders as the sub-4% mortgage returns, but high rates have pushed over 300,000 people into poverty, according to the IFS. And as more people use cash to help them budget, the Royal Mint has had to reassure us that they're not ditching 1 and 2p coins.
So, an awful lot to go at. We're going to try and rattle through, particularly the markets news. And we've got to start with that big tech sell-off, which has had a huge impact across US and Asian markets in particular. It started Tuesday night when, as I say, two of those magnificent 7 stocks delivered their earnings updates. We had Alphabet and Tesla reporting after the bell. And the day after, Wednesday, Wall Street's Magnificent Seven endured their worst day since September 2022, falling 5.9%, led by a 12% reverse for Tesla. Their struggles had a knock-on to the S&P 500. It had its biggest fall since December 2022, ending one of the longest runs without a decline of more than 2%. Tech-heavy, the Nasdaq Composite fell 3.6%, its worst day since October 2022, and the rout spread to Asia overnight and through this morning. The Nikkei fell 3%, the Hang Seng 2%. Smaller falls across European markets, and for once, London's lack of tech stocks has been a benefit. Now, let's start with Alphabet, which actually beat profit estimates. Now, they enjoyed a rise in digital advertising sales, up 11%, thanks in part to the Paris Olympics, and all of that cash, which is being spent on political advertising, particularly in the United States. But on the other side, the YouTube revenue didn't grow quite as much as had been expected. And the big one was how much cash they're still pouring into AI development. It means, Charlene, the numbers make your eyes water. So January to March, CapEx spend jumped 91% to 12 billion. It hit 13 billion in Q2. And what Alphabet have said is that they're going to maintain that level of spend for the second half of the year because, of course, of the battle for AI supremacy. That had initially sent investors' pulses racing, but now it's all about the cold, hard cost, and that is making many investors nervous. How much money needs to be poured in and for what rewards? Tesla, of course, I think we saw it coming, didn't we, with Tesla? We knew that this was going to be a bad quarter. We've seen deliveries not brilliant. They've really had to take a red pen to their sticker price to try and persuade people to buy their cars. And, you know, we saw profit margins getting an absolute battering, the worst in 5 years, just 14.6%. Now, remember, in 2022, it was almost 30%. It impacted profits, which had nearly halved compared to the same period last year, and forced Elon Musk really to go out on the offensive. I mean, he was really keen to point out that for him, Tesla wasn't about EVs. It's not an EV company. It's an AI company, a robotics company, and was making all kinds of announcements about the big humanoid robotics, that it would be started to be used in Tesla next year, available 2026 on the market. But of course, we've also seen its robo-taxi launch, which was due at the start of August, being delayed. So a lot of focus then on the core business, which at the moment is EVs. And of course, because competition's increased and there seems to have been a bit of a pause in demand, the transition to greener vehicles just seems to have sort of slowed a bit.
Yeah. I just wanted to stick with electric vehicles, as you say, or when is an EV not an EV, when it's a robot by the signs of it. But yeah, that transition is causing a headache for those traditional automakers as well.
It really is. I mean, it's a bit like AI in many ways, the amount of cash that needs to be spent to take companies to the forefront of the market is a massive amount. There are a lot of changes that need to be made to production lines, obviously just the development of the cars, the batteries, that kind of thing. And it's led to some companies putting the brakes on their EV plans. GM in particular, General Motors in the United States, has said that it's delaying its second US EV truck plant, also delaying the launch of its first Buick EV, which really sort of captured the attention of investors when they announced that. But its caution seems to have been rewarded because it announced adjusted operating earnings up 37% in the last quarter. Now, compare that to Ford, which delivered an earnings miss in what's been termed a brutal quarter for the car maker. I know it's had issues with warranty costs, but also their electric transition has really weighed. And it's a similar situation for the Japanese car maker Nissan, which this morning has issued a profit warning. First quarter operating profit slumped a whopping 99%. I mean, almost all profit. Yeah, it's incredible, isn't it? When you talk about that, all the profit it's made has pretty much been wiped out. So this is in the quarter that's just been reported. And I think when you look at UK production numbers, which are also out today, dropped almost 8% EV production in the first half of the year. And if you talk to people, do you drive an EV?
I do, yeah. I've got a full EV now. I went from hybrid to a full BMW EV. I can hear the boos now.
You see, I looked at a hybrid. We don't have anywhere to plug in an EV. And I have to say, at the moment, the price tag, the sticker price, still puts me off, particularly because I would have to hunt out somewhere to charge it. Yeah. And that is why the SMMT, the Society for Motor Manufacturers and Traders in the UK, is calling for the new government to give more incentives and support packages to motorists like me to make the switch ahead of the ban of the sale of new diesel and petrol cars by 2030. So, like AI, there is this sort of point, a lull almost, where we're waiting for the spoils of all this spend to be delivered. It feels like the momentum, we've got to a certain point where it has to tip at some point. But at the moment, it feels like, in terms of EVs, certainly a bit stalled.
Yeah, definitely. I mean, we got a charger. It was actually at our old house with the help of, the government grants a few years ago. So if I was doing it now, and then we moved that charger when we moved house, I think I'd be having second thoughts perhaps, or really appraising it. And again, it's the price tag is eye-watering, and it's really only possible for the way we do it through like a business lease. So yeah, definitely it feels like the incentives have gone and everyone's sort of waiting and seeing what's going to happen there. And I just wanted to, we've been talking about big spenders, and it seems luxury goods, as we mentioned, have also been suffering as those big spenders on handbags are actually maybe just checking what they're buying and checking their purchases now.
Yeah, I mean, luxury goods makers seem to be impervious to the cost of living crisis initially, as obviously people with deep pockets weren't feeling the squeeze in the same way as, us mere mortals. But there has been something of a shift, particularly in China. And we had an update from LVMH, which is really seen as the bellwether, obviously Louis Vuitton, Moet Hennessy, because it's huge. You know, it's 75 companies. It spans the whole gamut. It's got watches, champagne, and things like cognac and handbags. And its sales grew just 1% this last quarter, had been expected 3%. Now, the big issue has been in Asia. Sales down there 14%. And it's not alone, because many of its competitors are also seeing sales slow in the world's second largest economy. Now, not only are Chinese shoppers sort of cutting back on what they're spending, obviously, we thought that the Chinese economy would really sort of get back into forward momentum after the COVID issues had been sorted out at the beginning of the year, but it's really taken its time. And in addition, we've got a situation where government censors have shut down a number of social media accounts of influencers who have been the ones tempting people to buy those goods. So those people who might have looked at the latest bag from an influencer and thought, I've got to have that, are now not seeing that stuff. So we've got shares in LVMH, obviously home to Louis Vuitton, Dior, Tiffany. They've fallen almost 20% in the last year as investors really sort of take stock of this. We've got Burberry having quite a torrid time. It announced that sales in mainland China had fallen by 20% in its latest update. The Swiss watchmaker, the Swatch Group, which owns the likes of Omega, again having issues. Richemont, which owns Cartier, also issues. And Hugo Boss, the German fashion giant, actually issued a profit warning this week about weak consumer demand in markets like China and also in the UK. So lots to keep an eye on. We've got Prada owner Kering reporting in the next week or so. So yeah, it's something that I'm sure we'll revisit.
Yeah, and just finally, last couple of market bits, we've got some mixed news from the rival low-cost airlines. Some doing better than the others.
Yeah, EasyJet bucking the trend of lower fares, forecasting a record summer. Its last quarter saw a 16% increase in profits, 8% more passengers carried. This is despite Easter falling into March this year. So this is, quite an achievement. But at the same time, you've got Ryanair saying that profits are down 46% and that it's not going to be able to charge the kind of prices that it was expecting in terms of ticket prices and in terms of all those other extras, which passengers, might buy the add-ons like, I don't know, putting your bag in the luggage hold, that kind of thing. Stuff we used to take for granted as part of the ticket price, but, it doesn't happen anymore. But it did raise questions, Ryanair, about how far travelers are willing to be pushed before they say they are not paying that amount. Post-COVID, we all wanted to travel. Where was the first place you went?
Oh, this is a bit extra, actually. We went to the Maldives.
Lovely. We managed Barcelona.
I love it when you put me on the spot there, Danni. Well, to be fair, actually, mid-COVID, when things opened up, we went to Corfu kind of 1 September, October before my kids started school. So we'll stick with that one. That's a bit, yeah.
But that's it, you see. I mean, we did see particularly those long-haul destinations becoming really popular because people hadn't been able to go anywhere. They'd not been able to spend their money. They, maybe had to do a bit of camping or, a nice holiday by the beach in the UK if they could do it. But they had that pent-up demand and they had savings. And so they were willing to put the money in to enjoy travel again. But now there are questions about how far that can be pushed and about capacity as well. So, of course, we've had another sort of update from Heathrow. It hit record passenger numbers in the first half of the year. And now, of course, talk again has turned to whether or not it needs that third runway. So, Travel's an interesting one. And of course, we're still seeing issues for Delta Airlines over in the United States following the big crowd strike debacle, which we just don't have time to talk about today. But obviously, it really impacted not only CrowdStrike's share price, but also so many other businesses. And I've been looking at some of the tweets from some Delta passengers, and they're still having issues now. Most places have managed to get things back up and running fairly quickly. But you've got stories of grooms not making it to the altar in time because they couldn't get flights. I mean, this is just horrible stuff.
Oh, it really is. And just to kind of finish off on our market update, we've had an update from Unilever, which we've been keeping a close eye on because it's the first one since it announced turnaround plans.
Yeah, and it was mixed. It beat first half profit expectations because of resilient pricing, but sales growth, which is really where investors were focusing, that disappointed. So a 3.9% rise in second quarter underlying sales, below the 4.2% increase expected. And it kind of suggests that this growth plan from Heinz Schumacher has really failed to gather steam. It's looking to focus in on just a few products, power brands. It's announced it's spinning off its ice cream division. That was part of the turnaround plan announced earlier in the year, and is in the process of cutting 7,500 jobs across the group. But it's interesting to see that momentum because we've also had an update from another consumer goods giant rival, Reckitt. It's announced very similar plans to what we saw from Unilever to try and really focus on the key brands where it sees the opportunity for growth and the opportunity to win back customers they might have lost, maybe to charge a bit more. Ian Conway and Tom Sieber from Shares magazine discuss what led the company to take such a drastic move, selling off large parts of the business. They talk about the history of the company and consider what its future might hold.
So, Ian, today we're talking about consumer goods giant Reckitt, which still trades as Reckitt Benckiser on the stock market. And it's an opportune time to do so because it's just announced plans to sell off a significant chunk of its portfolio. Basically, this is its home care brand, so that includes things like Air Wick and Sillet Bang, which generated sales of 1.9 billion in 2023. So it's it is a significant part of the business, and the focus is now going to be on what have certainly recently been more profitable health products like Strepsils, Nurofen, Durex. Before we talk about why the company is doing this, perhaps it's worth having a look at the background and how the last few years have led to this point, with the shares still trading despite a reasonably positive reaction to this announcement, close to decade lows.
Yeah, Tom. So Reckitt Benckiser, I mean, as you mentioned, all the products are really familiar to us. They're on TV all the time. The Gaviscons, the Sillet Bangs, Calgons. And it's got a sort of first world feel to a lot of it, because these are, the company's fairly staid. It does products that keep your washing machine running. You make stuff smell nice, as you say, Airwick. But actually, Reckitt is huge in emerging markets, and that's really important because in developed markets like the UK, Europe, and the US, there's been a lot of pressure on prices. Most recently, cost of living crisis. But also, consumers have been trading down. They've been saying, well, do I really need to spend a couple of pounds on a packet of Nurofen, say, when I can go to a supermarket and get the own brand product for, quarter the price? Whereas, in developing markets, premium brands are really trusted. And that's really crucial for a group like Reckitt, which sells a lot of its goods in emerging markets.
Definitely. I mean, yeah, there just isn't the same kind of safe, I guess, own brands available in those markets, is there? So that there isn't that pressure coming for Reckitt.
No, there's brand loyalty is really big in those markets because, as you say, I mean, you don't want to get some product that's just been knocked up in a corner shop somewhere. You need that. You need to be sure that. So, for example, something like Dettol. has got a fantastic reputation in India and Asia, you know, as a cleaning product. So that's kind of the background to Reckitt. But things are going. I mean, it's never been a very dynamic company, but in 2017, the chief executive at the time thought he'd take the company in a new direction and get into infant formula. So bought US for Mead Johnson Nutrition for
Yeah.
$18 billion. Now, that was a lot of money back then. It's a lot of money now. Um, but Kapoor was a an interesting guy. He's a Reckitt and Coleman guy, so he predates the merger. He started where he was working for the firm for 20 years before this. You know, he made this deal, and he'd managed the Indian and Asian businesses. So he was really focused on that area of the world. And what he wanted to do was make Reckitt into what he called a sort of cradle to grave. So, you know, all the way from infant formula. So people had this brand loyalty all the way through from infant formula all the way through their life to all the different products as they, you know, and of course you got this growing middle class in India. So more people are going to have appliances or more people are going to want air fresheners, this type of stuff. Unfortunately, it was a complete disaster. And the Mead Johnson deal just didn't wash its face, and it ran into huge problems in China as well. So they lost billions of dollars on it.
Yeah, I mean, it's got to be up there with one of the worst, sort of, certainly in the UK market, one of the worst corporate deals of recent memory, hasn't it? No question.
Yeah, I mean, huge value destruction. And it's funny because Kapoor always said, you know, culture trumps strategy. And I guess having been in the business 20 years, he really felt that Reckitt culture was really strong. But strategically, that was a terrible decision.
Yeah, yeah, absolutely. No, it's certainly been proved to be such, hasn't it?
Yeah, I mean, the good news is for shareholders that a new guy came in, Chris Licht, ex-PepsiCo executive. He came in 2019. Um, Unfortunately for him, of course, you know, he came in September 2019 and 6 months later the pandemic hit, but it was always on his to-do list to basically reshape the business. And now that we're through the pandemic and lockdowns and, you know, sales are getting back to normal, now, I mean, I think it was late last year he said he was going to start the review process in earnest now that sales had stabilized.
Yeah.
And so we got this week's announcement.
Yeah, absolutely. I mean, I suppose it's fair to say that in some respects they didn't have a bad pandemic, did they? Because having a portfolio that was heavily sort of tilted towards health and hygiene was probably, you know, helpful to it. So it was a bit of a kind of, you know, obviously there was significant disruption like there was for any business, but there were some things about the pandemic that played perhaps in Reckitt's favour a bit.
Yeah, yeah, absolutely. But unfortunately, you know, since then, shares have just continued to drift. I think the broader narrative of people trading down, um, volume growth being disappointing. You know, most of the growth has come through price increases, and you've got to be really savvy about how you raise prices on these everyday items.
So, as you say, Chris Licht had sort of teed up this latest move last October, when he kind of promised to sharpen up Reckitt's act and kind of improve its what is a fairly, I mean, some might say unwieldy suite of products. The announcement, sort of the recent announcement, also comes after it emerged in May that activist investor Eminence had built up a stake in the company, and activists often look for businesses to streamline their operations and focus on what, you know, they're really good at, the bits that where they really excel. So I guess, you know, I'm not saying that this purely, you know, clearly Chris Licht was looking at making changes to the business anyway, but obviously, you know, it's kind of somewhat in line with what perhaps Eminence is looking for. It's worth noting that going back to Mead Johnson, Reckitt has announced it's going to review options for this infant formula business. I mean, you know, as we discussed, it's been an absolute disaster of an acquisition, and you know that became more serious, I guess, earlier this year when there was a court ruling which awarded damages to the parent of a child who died after taking or using one of its infant formula brands. So that's kind of led to a big litigation problem for Reckitt in the US. I mean, you'd sense, wouldn't you, Ian, that would make offloading it fairly difficult. But even if it could achieve a good price, it might be worth it just to give a bit of certainty and, focus the investment case, and people can sort of forget about that liability, I guess.
Yeah, I think shareholders would be very glad to see the back of that business.
Yeah.
The essential home care brands, as you say, so stuff like Calgon, Cillit Bang. I don't know. I don't know about the strategic logic of selling those. I get reducing the scale of the business for sure, and taking flags off maps is a good thing. And yeah, you're right. I'm sure the presence of the activist would have been one of the factors that the new CEO has taken into account. But yeah, I mean, how much they can actually rescue of that 18 billion that they invested in Mead Johnson's a moot point, and that's not
I've
releasing
seen figures around 5 billion quoted, basically, because you're going to have to offer discount for these, the potential liabilities associated with the litigation. So yeah, I mean, who knows? That's obviously a number. Well, I'm sure it's a calculated or kind of educated guess, but it is a guess. But yeah, it seems unlikely they'll recover a lot of that value.
Well, what they've suggested is the money from selling the essential home care brands, they'll return to shareholders through a buyback. The money from the sale of Mead Johnson will be used to pay down debt.
Okay, that's interesting.
That's as far as we're aware. So when the company announced this, I mean, the shares went up. That was quite good. However, at the same time, it announced that ironically, it is the nutrition business which has suffered. There was a storm in the US that affected one of its manufacturing facilities, and so sales are going to miss forecasts this year. But underlying growth in the hygiene and the health segments is decent. I mean, it's low single digits, but it's mostly volume driven rather than price nowadays. And the other thing that struck me when I looked at the results was the gross margin of 60%, which I think surprised a few people. That means that every pound of sales, it costs you 40p to make and sell the item. That's your cost of goods sold. So you're making 60p in every pound on everything you sell. That's an attractive ratio. That gross margin, as it's known, is something that Terry Smith and a lot of other investors will always reference and say, that's a sign of a quality business, a high gross margin. Because then if you get inflation and it eats into that margin, that's not so bad. And actually, when you look at the underlying earnings of Reckitt, they haven't been a disaster. Whereas the share price is at 10-year lows, the earnings haven't been that bad. Sentiment is very, very much against the firm at the moment.
Yeah, absolutely. Sentiment is very poor. Maybe it's worth sketching out a little bit, as much as we were able to, the sort of timeline we're expecting in terms of this whole thing. I mean, it's not going to happen overnight. It's a big strategic move of this scale. It's obvious that it won't. But what is it looking like in terms of how long it might take for all of this to play out?
Well, the suggestion is by the end of 2025. So you would expect them by this time next year to have a plan in place for the essential home care business, that nearly 2 billion of sales unit. Obviously, Mead Johnson is, the timeline is the same, but I think it's going to be, as you said, with the litigation risk, I think that makes it a much tougher sell. But yeah, so we're looking really at 18 months to pull this off. After which money will come back to shareholders. So, in the meantime, I noticed that, a couple of brokers put out notes and they're saying, we're not changing our earnings forecast, we're not changing our recommendation on the stock. So it had that nice pop on the day when they announced it, but that kind of faded too.
I suppose.
So we'll just see.
Yeah, the market's never that patient, is it? So I guess the fact that, it is going to be quite a long time before all of this kind of comes to fruition, it's not a surprise that really, it could be a bit in limbo potentially until all of this is out clear of its hair and kind of done.
Yeah, I mean, if you compare it with, say, Unilever, which has jumped 7% today because it's come out with much better margins, that's another business where there's an activist. It's got a big suite of brands. It's under pressure to, streamline itself. There's talk of them saying, they've said they're going to separate the ice cream business as well. That seems to be, Unilever to me seems to be a bit further down the road in this process, and so you get that kind of reaction. And it's a equally big stock in the same sector. I think Reckitt's going to just have to do its time basically until investors turn more positive on it.
That makes sense.
Ian Conway and Tom Sieber there from Shares Magazine, and do seek it out if you haven't already. It's packed full of insight and analysis and great companion piece to this pod. All right, Charlene, let's talk mortgages because there is a bit of good news.
Yeah, so Nationwide, Britain's biggest building society, is reintroducing the sub-4% fixed mortgage rate. So hopefully this means further signs of competition in the market heating up. So we've seen, obviously, other lenders start to cut their rates in the hope that Bank of England rate cut will finally be here. I feel like we're always looking over our shoulders. But from Wednesday, Nationwide will be reducing rates by up to 0.25 percentage points across its fixed rate products. So it's 2, 3 and 5 year fixed rate products. And the lowest will now come in at 3.99%. And it last offered sub 4% rates in early February. So this is good news for these new customers, these first time buyers, which this product is sort of targeted at. So yes, that new 5 year fixed rate will be at 3.99. It does come with those who are lucky enough to be able to save a 40% deposit for their first home. And, it is a mixed picture. It's still pretty volatile out there because at the same time as announcing these reductions to fixed rates, their tracker rates will be going up. Maybe not a massive surprise, 15 percentage points, 0.15. So as I say, whilst fixed rates are kind of on that downward trend, as we've seen throughout the market, it's still a mixed picture out there.
And I guarantee we'll continue to talk about Bank of England and rate cuts. Few are expecting that we will see a shift on the beginning of August. So we'll update you in our pod when we come back in September. Now, the rapid increase in the base rate that we saw has had the knock-on to mortgages that we were just talking about, and that's had a huge impact on some homeowners.
It really has. So figures from the IFS have showed that these mortgage rate rises, as they kind of pull through to the economy, have pushed an estimated 320,000 more people into poverty. And that was by the end of December 2023. So if we think about it, back in 22-23, the average mortgage rate was around 2.3%. And that just translating into interest payments of around £240 a month for a typical household with a typical outstanding mortgage. But a tenth of households face mortgage interest rates of at least 4.7%, equivalent to £490 per month on the same sort of metrics. So we're really starting to see those effects pull through, and the numbers are quite worrying. And I think there's a concern out there, and the IFS have highlighted this, that the real poverty figures are understated due to the fact that the way official poverty figures are measured using that single rate assumption. So it's probably no surprise that those remortgaging throughout 2022, 2023 are now more likely to fall into arrears on bills than those with mortgages who hadn't remortgaged in that time. So I think it's a worrying picture will continue, and a trend we'll sadly see continue.
Yeah, I mean, it's quite interesting because, of course, if people got a fixed rate in September 2022, if they're coming up for renewal this September, they might actually see a fall, whereas up until now, everyone that's come off a fixed rate has seen an increase. So, yeah, we'll definitely keep an eye on that. And also a big impact on the overheated rental market, because the latest figures from UK Finance show a fall in the number of buy-to-let mortgages over the past year.
Yeah, so buy-to-let house purchases themselves more than halved over the course of 2023. Again, these numbers are from UK Finance, as you said. So the number of new mortgage deals fell from just over 25,000 in the last quarter of 2022 to just over 12,000 in the first quarter of this year. So again, obviously rapidly rising interest rates play the major role here. It's making it harder for landlords to pass affordability tests. But, we've seen rents go up, but of course so have costs. And that just puts a squeeze on landlord profits. So as well as mortgage costs, you've got the kind of continuing impact of stamp duty surcharges that came into force. What was that, nearly 8 years ago now, and the removal, of course, of higher rate relief on mortgage interest payments. One thing that surprised me a little bit was a third of the buy-to-let market is actually comprised of landlords with just one property. So not these kind of wild big portfolios that maybe you expect or you hear about. And just 10% of those with buy-to-let mortgages are structured as businesses. So I wondered, sort of thinking about this when we said we were going to talk about it, if we'll see more people structure in this way as you start to see double or triple rates of council tax in those popular tourist hotspots as councils try and cash in on second home and holiday homeowners, but whether or not they'll be successful if people are able to kind of flip into business structures, it remains to be seen.
Yeah, obviously interest rates played a huge part in all of this, and we know the relationship between interest rates and inflation. Everyone's been talking about it for the past few years. But do you know what reflation is? To find out more, Dan Coatsworth recently caught up with Sunil Krishnan from Aviva Investors to chat about this topic and to find out how Sunil is positioning portfolios in the current market. Let's hear what they have to say.
Well, Sunil, I think let's start with the absolute core question here. What exactly is reflation?
Well, as your listeners will know, inflation is the speed at which prices rise. And I guess you can think of it like the speed of your car. So inflation, you move forwards. Deflation, hopefully not too often, you drive in reverse. Reflation is a period where either you're hitting the accelerator, so the speed of price rises is increasing, or a period where you were hard on the brakes, but then you ease off. So the loss of speed gives way to something that's a bit more stable.
Okay, perfect. So, I mean, obviously it's relevant this year, isn't it? We are going through a period where I think monetary policy is changing. We've already seen some central banks cut interest rates. I think there's expectations that we'll see more this year or certainly next year. I mean, obviously, this is front of mind for everyone, isn't it, at the moment?
Yeah, I think the interesting point here is where we've come from and the impact it's had on investor mindset and sentiment. We ended last year with a lot of confidence from economists and investors, which should always be a bit of a warning sign when everyone agrees. But the agreement was that we were actually going quite hard on the brakes across developed markets after the runaway inflation of 2022 and 23. But actually, in the early part of this year, the progress of getting inflation down didn't really follow the script. It's still above central bank targets in the US and Europe, and it's not expected to stay at target, having briefly dipped towards it in the UK either. And at the same time, economic growth and employment, we generally think a bit about those rather like the pedals of the car. So strong growth in jobs accelerate inflation and weak activity breaks it. And growth and employment have actually been better than expected this year, especially in the US, the biggest economy. And that's a bit like firmer pressure on the accelerator. So investors are having to adjust to inflation being a bit stickier and growth a bit stronger than they were expecting. They did think that the car was slowing quite sharply, and it just hasn't turned out that way.
Well, I think lots of people just assume that if we get inflation falling back towards the sort of the targets by the main central banks, it's going to be brilliant for equities. I mean, what impact does the broader reflation scenario have on sort of assets across the board?
Well, when investors were thinking that the brakes were being pushed hard, they expected inflation and interest rates to be falling quite fast. So as you say, central banks declare victory and start to cut rates. And generally, when you see that combination historically, it's been a great time for fixed income assets like government bonds. And if you look, for example, at Q4 of last year, government bonds, particularly in the UK, rose really sharply in price. But actually, they've struggled a bit this year because investors have positioned more in that reflationary way. On the other hand, if you look at the stock market, for example, markets have reassessed and said, well, if we've got solid economic growth and inflation's a bit sticky, that's actually great news for company profits. And so you've seen double-digit gains in global equities since the turn of the year. And also investors positioning for stickier inflation can be good news for commodities. They do tend to hold their value as prices rise. And so, for example, we've seen gold prices up nearly 15% in sterling terms year to date.
So, I mean, obviously, inflation, there's certainly data come out recently which suggests across in many parts, many sort of core areas, it's coming down. But equally, there's talk that later in the year, we could easily see inflation moving higher again. What might be the sort of the key triggers to push inflation back up?
Well, the most obvious one is that we still remain quite sensitive to global supply chains, both in terms of how they affect the price of goods like raw material inputs, energy, metals, food and agriculture, but also to the processes behind those supply chains like shipping. And shortages in shipping capacity can lead to difficulties in pricing as well. And again, we did see that a bit even before the invasion of Ukraine. Even in 2021, there were signs that shipping prices were struggling a bit. And the point about these supply chains is that disruption in them can be hard to predict. We found that with the energy crisis following on from the Ukraine invasion in 2022. But even when you had a large container carrier getting stuck in the middle of the Suez Canal, it's just not really what people were expecting, but has these unforeseen consequences. The other risk that's perhaps a bit closer to home is that when the job market has been strong, you have seen quite a few above inflation pay rises. And if the job market remains strong or even accelerates, you might well expect to see more and more above inflation pay rises. And that tends to be a big driver of the prices of services like retail or office services feeding through into inflation as well. So that's another risk. I mean, fortunately in the UK, I think we're probably looking at a job market that is softening a bit rather than speeding up, but it is something that we're having to watch quite closely.
And how are you positioning portfolios at the moment with all this in mind? Are you in a different situation than perhaps you were thinking at the start of the year?
Well, I mean, certainly reflation as it affects financial markets is something of a state of mind as far as investors are concerned. So we are having to stay quite nimble. I mean, I guess what I would say is that we do see equities as the key beneficiary of solid growth and inflation that's a little bit sticky. So compared to earlier in the year, we have increased our weights in stock markets. And we've really done that across developed equity markets at the expense of government bonds. We also do maintain gold positions in our more active funds, but I guess you would see that as a more strategic position, that it's always there in case of disruption to pricing in the monetary system rather than a short-term call.
Yeah. What about bonds, though? I mean, this is, I think a lot of our listeners will hold bonds. I mean, over the last few years, they've been sort of quite a sort of testing asset to have in your portfolio, not perhaps performing as expected. At what point do you think bonds might be a bit more interesting to look at?
Well, I think it pays to pay attention to where reflation might be more of a risk or more likely to be ongoing, and where potentially it will run into natural limits more quickly. Now, I think the good news for listeners is that actually the UK as an economy is probably one where we wouldn't expect reflation to run too far. As I mentioned, I think we are seeing some signs of softening in the job market, which will, if you like, ease off on that accelerator. I think we are also likely from a fiscal point of view, perhaps not to see a huge amount of generosity from the new government in terms of significant fiscal expansion. So you put those things together, and it should provide an environment where the Bank of England can turn to looking at lower interest rates in the second half of the year. And so I think that potentially provides more limits. But actually, that puts the gilt market into a good position compared to other global bond markets. If, for example, you look at the United States, where the job market does still seem to be in reasonable shape, the housing market likewise, and equally we're heading into a presidential campaign where the two parties, it really seems, are falling over each other to make more and more generous promises in terms of their spending plans. And there, I think you could see reflation run for a bit longer. So I think maybe a bit of differentiation between different regions could be quite an important key to maybe finding better valued bonds or ones that are better prepared for the future.
That was Sunil Krishnan, head of multi-asset funds at Aviva Investors. Now, Danni, do you carry cash?
Do you know, at the moment, I do actually have a tenner in my wallet, and it's unusual for me to have any cash at all. But my daughter gets tips in cash, and she owed me some money. And she said that she would rather hand over the cash because she spends everything online. You know, she uses Vinted quite a lot. So I do actually have cash. So that means that at lunchtime today, I can go to the fish and chip shop because they only take cash. So it's exciting.
Oh, no. That sounds delicious. And I'm now thinking about my lunch plans, sat here ready to go to the gym, actually. So, yeah, same. I mean, unless it was the tooth fairy or maybe, you know, foreign currency going abroad. But I did have a grumpy moment when I was parking my car at Wilmslow train station to come down and see you lovely guys in London. And they offer an app in the car park that you can pay with. And I've always just automatically used this. But what I did notice is the extra charge for doing so definitely has gone up. It was about 40 pence a pop now. And that's fine if it's like the overnight parking. But if it's like a couple of hours here and there in town, that's nearly like 40% on your kind of pound here or there. So yeah, I'm definitely going to be like getting out the pound coins, maybe borrowing from my kids' tooth fairy funds. But yeah, kind of back to the stats, and another one from our friends there at UK Finance. 1.5 million adults mainly use cash in 2023. And that was the first rise since 2019. Now, it's likely, in their opinion, and I think I agree here, due to people being a bit more cautious with their spending and budgeting more tightly, of course, due to cost of living crisis. And I guess, yeah, it does feel like more of a considered purchase when you're handing over that kind of cold, hard cash rather than tapping away on the phone. However, younger people, I don't know why I'm trying to put myself in this group, but Young is my surname, but that's about it. They are using contactless on smartphones, smartwatches, and that's as high as 75% as their main spend, which is probably not too surprising. But just a quarter of 45 to 54-year-olds use mobile. However, that gap is expected to narrow in the coming years. So just an interesting little nugget there.
And I did see a story today about 1 and 2p coins, and I'm guilty of having a jar full of these things, which I've had in the cupboard for a couple of years. But there was a big sort of concern that 1 and 2p coins were going to be phased out because the Royal Mint had decided it wasn't going to mint anymore. But that, it says, setting all of our minds to rest, is not happening. It's just that they don't need to make any more because there are so many in circulation. And obviously that requires people like me to actually take them out of the cupboard, out of the jar, and to actually use them. Because when people were talking about this, it was really interesting. I saw on social media lots of people commenting that if you got rid of 1 and 2p coins, that would mean that all those $1.99 purchases, they wouldn't come down. No, they'd go up, wouldn't they? So actually, we could potentially all be out of pocket.
Exactly. I mean, stand down if you were particularly worried that these were going to disappear. Like you say, it's just no new orders. But yeah, like anything that's 99p. I mean, it's more pound shops than 99p and all of that, isn't it? But yeah, they're not going to be taking 99p off.
Before we talk about self-assessment briefly, let's get an update now on the performance of AJ Bell funds from Head of Investment Solutions at AJ Bell, James Flintoft. James, thanks for talking to us.
Hi, Danni.
So what have been the main talking points for markets this quarter?
I'd say there were 3 or 4 talking points really dominating at the moment. Inflation is still there as a theme, and obviously the impact that can have on interest rates. Also economic growth and judging the recovery from the recession that we've had in the UK. And then on top of that, politics is really comes to the fore at the minute. Generally, the mood in markets has been good. Economic growth seems to be picking up in a couple of key regions like the UK and China. Inflation is coming down. Notably, in the UK, inflation is now back at the 2% target, although it might bounce back up a little bit in the coming months. And that's prompted the Bank of England to think closely about interest rates and where they're going to head. They've obviously held off in June because of the surprise of the election in early July, but they'll be revisiting that conversation in the coming months, I expect. In terms of politics, that's really come to the fore this quarter, from South Africa, Mexico, India, and France now. It's having a real impact on markets. So that's something that was expected at the start of the year, but it's really coming to the fore this quarter.
So James, how did equity markets respond to all those things?
Equity markets had another decent quarter on the whole. The US did well again, but it was joined by regions such as the UK and emerging markets. In the UK, there's been a spate of takeover offers, which has lifted the mood a little bit. International investors are looking at that more closely. And also, of course, we've got the election, which provides the opportunity for some form of clarity and possibly stability, which also international investors have been wary of in recent years. If we look at other developed markets like Japan, that's gone off the boil a little bit. There's been some weakness in the currency over there. So too in Europe, because of that surprise French parliamentary election. That caused a sudden drop in the French market. Over in emerging markets, there's been some good news really. China's looking brighter in terms of economic growth. The market's picked up after a pretty bad couple of years. In India, it was a rocky quarter. There was a slight surprise in the election results over there, but on the whole, it performed pretty well.
And what about bond markets?
Bond markets have been a bit quieter, and that's been a relief really after the last couple of years. Government bonds haven't done so well this quarter, which isn't so much of a problem for portfolios when equity markets are performing so well. And there's a sense that actually, where should equity markets perform poorly, they may actually do their job and protect the portfolios going forward. Corporate bonds have had another decent quarter of returns as well.
So with politics seeming to influence markets so much at the moment, how do you deal with that?
We generally try not to make these sorts of events influence our thinking. Generally, we don't believe that we know any more than anybody else and what the market thinks, what's included in market pricing. Even if we did have some sort of special insight, then we'd have to think about actually how that impacts markets. And that's an entirely different matter as well, and very unpredictable. So generally, we try to sit back, think about the long term, just make sure that when we're constructing the portfolios, they're ready for some choppier times that may come about with the elections, but equally may not come about as well.
Let's drill down then into AJ Bell funds. How did they perform over the second quarter and in the year so far?
Generally, another good performance from the funds. The returns have been fairly progressive across the growth range of funds. And by that, I mean that the higher risk portfolios have delivered the highest returns. Over the 1 year, that persists for most of the funds, apart from the Global Growth Fund, where the Chinese equity markets had a struggle. And the returns there have been impacted for that portfolio in particular. If I think about the income funds, they've done okay as well. But actually, income-paying stocks or dividend-paying stocks haven't been quite as strong as their more growth-oriented peers in sectors like the tech sector in the US, for example. And then finally, on the Responsible Growth Fund, that's had another decent year and 3 months. But some of the returns in the US have been missed just by way of the construction of that fund.
So James, have you made any changes to the funds recently?
We haven't made any changes to the asset allocation since January. We do have a couple of ideas that we're looking into, but it's too early to suggest that we'll take any action on those. Generally, we're trying to position these portfolios for the long term, and that means that we don't interfere in how they're positioned too often.
James, look, thanks so much for talking to us. We look forward to catching up with you and the rest of the team throughout the year.
Thank you.
Right. A really quick reminder for people then, Charlene, about self-assessment payments.
Yes, self-assessment filers, set your reminders as any payments on account are due by the 31st of July. Now, I'm feeling particularly smug as I've also just today filed my tax return for the 23-24 tax year. Now, plenty of listeners are probably like, big deal, I've already done mine, but maybe you're far more organised than me, but this is definitely progress for me. And actually 300,000 people did it in the first week after the tax year end. at 5th of April, but I had to sort of wait around for some interesting investment statements just to double check the figures. So if you can file early, it's a good idea. For me personally, it helps me to know well ahead of time what's due and when. And this year it will mean no kind of pre and post Christmas rush, and hopefully a gold star from my accountant. Maybe not. I think I've caused him enough stress over the years. It can also really help if you're in need of earnings evidence for mortgages, such as we talked about today, or if you actually like to use the budgeting and payment plans on offer for HMRC. And HMRC themselves, it's well known they're suffering a bit of a resource crunch. So it does put you in at the front of the queue for any rebates or any queries that they've got. So if you can, it's a good idea to plan.
My accountant actually has a charging structure. So if you get your tax stuff to him early, you'll pay less than if you're one of those ones in the mad rush at the end of the year.
Accountancy surcharge. It's like a Uber surcharge pricing. I love it. A good bit of behavioural incentives there.
Oh, I love it. Bit of bragging from you about self-assessment to end our pod. And just a reminder that Money and Markets is taking a break. The pod will be back at the beginning of September. I reckon that will be another bumper episode. Have a great summer. Don't forget to subscribe so the next episode will pop into your feed the moment it's released. And if you can't wait till September, do take a listen to our sister podcast, Money Matters, which is aimed at helping women whittle away at that gender investment gap. The next episode is all about risk. Thanks for listening.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.